We can get started. Welcome, everybody, to the State of Capital in Entrepreneurship webinar. My name is Varsha Kalavar, and I work on the growth team at SecondMuse. And we're so excited to share the results of the 2022 State of Entrepreneurship survey that we've been working on. In 2020, we launched our first State of Entrepreneurship study to highlight the needs of entrepreneurs across the country and better understand their outlook on the economy as a whole. 2 years later, we conducted another iteration of the study, which we are excited to bring out to you all today, that highlights a number of new challenges that entrepreneurs are facing as we head into the recession. A couple of housekeeping things before handing it off to our host for the next hour. Everyone will be muted for the duration of the webinar, but please feel free to put questions in the chat and we'll address them as we go or at the end of the webinar. We'll be recording this session and we'll send you the link to share with anyone else who may be interested to watch and couldn't make it today. And just a reminder, on the top right of your Zoom screen, switch your speaker view to, or switch your view to speaker view so that you're able to see the spotlight on all the panelists. With that, I'll hand it over to Erica Barbosa, the Global Head of Sustainable Finance and Innovation at SecondMuse, who will be hosting the panel. All you, Erica.
Thank you, Varsha, and really delighted to be here with everybody. Thank you for joining us. Eric, I'm with SecondMuse Capital, the impact investing firm from SecondMuse that is set up to manage and venture impact funds, as well as we have something called the Future Economy Lab, which is a research and design service to develop investment instruments that feel and operate and are governed in more equitable ways for all parties involved. And so in that context, this study is very important for the work that we do. We're typically working with investors, with entrepreneurs, with a whole range of actors, and we feel things are changing in different ways. We hear about the challenges, about the opportunities. This study helps us, take the pulse in a more methodic way and sort of like complement our knowledge. And for today, a key theme that came out of the report, over 3/4 of respondents, we had over close to 1,300 respondents, 275 were entrepreneurs. More than 3/4 feel that the U.S. economy is not on the right track, and there are significant issues with inclusion, with equity, and a big piece of that is access to capital. And obviously, entrepreneurship is hard. There's a lot of barriers and challenges that come with that. And capital is constantly seen as a determinant of success or a big enabler in many cases. One of the themes and one of the lenses through which entrepreneurs seem to be thinking about this is this theme of generational wealth, or the lack of generational wealth, which seems to have a big impact. So that's what we're going to be diving deep into over the next session. But before we do that, I'm going to please invite our wonderful speakers today to introduce themselves. Please, tell us a little bit about you, what you do, and then what excites you about what inspires you and excites you about your community. And we can go in alphabetical order by name. And Aaron, I'll pass it on to you, Aaron Fitzgerald.
Thank you, Erica, and thanks for having me. Hi, everyone. I'm Aaron Fitzgerald, CEO and co-founder of Mars Materials. We're working to store captured CO2 into long-lived products like carbon fiber. And we're doing this by commercializing process technology called nitrylation, which is technology developed by the National Renewable Energy Laboratory, or NREL. And we're using this process to create cheaper and lower carbon drop-in replacement acrylonitrile, which is a scary name for a chemical, but it's the main raw material for carbon fiber and many other modern products that we all use and love, from our rugs to our vacuums to our keyboard keys. So our technology is anticipated to reduce the cost of carbon fiber, which will unlock new applications for that material in vehicles for lightweighting, electrical grid parts, and building materials. We estimate that cumulatively, our technology can remove and offset nearly 1.4 gigatons of captured CO2 by about 2050. Just by visualization there, that would mean covering about a third of Africa in trees. That's kind of the impact that we'd have. And then today we are venture backed and grant funded. And we're currently recruiting team members to help scale our technology to demonstration scale. So if you or someone you know vibes with our mission and you're interested in our VP of engineering role or process engineering role, please consider applying, and you can learn more at marsmaterials.com/jobs. In terms of what inspires me about my community, I'm a Black queer founder and I escaped poverty. So I represent a lot of communities, and what inspires me about each of them is that each of these inherited communities I'm a part of are just known to be resilient. And as someone working in climate, I am just so fortunate enough to also have chosen this community. And for the same reasons I just described for resiliency, what inspires me about the people who work in climate is their ability to be resilient. What we're doing to really course correct a century of pollution is hard and it's unprecedented. And the goal really seems to change every day. The goal pulls itself. And I'm not always sure that capitalism is the right mechanism for that change. But through all this uncertainty, I think more people than ever are really flocking to do the hard work, the actual hard work, which is to take climate action. And that's very inspiring. So I'm excited to be here. Thank you.
Thank you so much. That's a wonderful intro. Arturo, please.
Gracias, Erika, and thank you everyone for having me. My name is Arturo Franco. I am a Senior Vice President at the Center for Inclusive Growth, which is Mastercard's social impact hub. I've been at Mastercard for about 4 years, and what we do is we basically use all of the assets of the company, our talent, our data, our technology, and also the funding from the Mastercard Impact Fund to try to solve some of these inequities in the economy, to try to push a new vision of what a more inclusive economy, a more sustainable economy could be, and to support entrepreneurs and small businesses and people in their financial journey. And so I also teach a course on global inequality at the Monk School at the University of Toronto. I've seen 2 of my ex-students on the list today, so very happy to see them here. And I think for both of the communities that I engage with, my colleagues and my students, what I would say inspires me is just how passionate and committed people are to building this new world. People like Aaron inspire me as well, because they've been able to deal with what we have right now, which is not great, and that's why we will never be able to go to the normal we had before COVID, because normal was not good enough for most people. But kind of pushing forward and building a new inclusive, sustainable, equitable, and fair economy, which is what we're trying to do.
Wonderful. Thank you. Thank you very much, Arturo. And glad to have you here. Jeff, I'll pass it on to you.
Thank you. So Tanchi Ani Bojo, everyone. My name is Jeff Sear. My traditional name is Inane, which means Eagle Man Leading. I'm an Indigenous Métis person from southern Manitoba in Canada, and a happy father of 5 kids, not so little anymore. I'm the managing partner and co-founder of Raven Indigenous Capital Partners and the CEO of the Raven Indigenous Impact Foundation. And what we are and do is we are an Indigenous financial intermediary, North America's only Indigenous-led VC currently. We run 2 Indigenous impact funds, which are impact first, focused in the Indigenous space. And what we're really here to do is increase the well-being of our people as an overall mission statement. That looks like, for those 2 funds, investing in Indigenous enterprises, usually folks like Aaron, early growth stage venture capital. We raised our first fund and completed it, raised 25 million and completed that. And happy to report we're raising a second $85 million fund, which we're more than halfway through the raise in a little bit of record time. So pretty excited about where that's headed. On the other side of our work is outcomes financing, where we do community level complex problem solving by co-designing and co-creating solutions with Indigenous people in their communities. I, like Aaron, come from a history of poverty for my family as Indigenous people in Canada, and I'm seeking to amend that, and issues like intergenerational lack of wealth and what that means in the venture capital, and then sort of the key issue areas facing our communities like climate change and health, and how we engage with that. So I'll stop there. Turn it back to Erica.
Thank you so much. That's wonderful, and we have three wonderful guests with us that have much to contribute on this particular topic. So maybe just to get into it, as I was mentioning in the introduction, generational wealth is a strong lens for entrepreneurs and how they're seeing the economy these days. Respondents with no generational wealth see the economy as significantly less inclusive than those starting with generational wealth. 29% of respondents with no generational wealth state the economy is not inclusive, compared to 12% with past generational wealth that believe that the economy is not inclusive. Now, when we talk about generational wealth, typically, at least the way that it's defined in this report, is the inheritance of the expectation of inheritance of different types of, whether it's assets, real estate, cash, etc. And so something that really provides a cushion or capital resources to put at work. So let me maybe if we can start with one question, and Aaron, I'll invite you to go first, and please others jump in. How do you think generational wealth impacts the journey of an entrepreneur, and what barriers does a lack of generational wealth pose as entrepreneurs are looking to start a business?
Yeah, that's a really great question, Erica. And I'm no business academic, so forgive me if some of my stats are wrong, but I think there are like a few reasons why businesses fail, and it's team, or a lack of having the right team. It's lack of kind of product market fit, and it's not having the right resources or capital to really be able to move an idea forward. And when I think about the issues of generational wealth and how that might impact your success or your failure of a business, it really starts with that lack of resources and capital. Our academic institutions, our investors prefer legacies, multiple time founders. And when you don't have generational wealth, it's really hard to continue to fail if you're a multiple time founder with not an exit, right? It's more challenging to get your name out there or to be respected, and all of that kind of brand authority is what really is demanded to really tap into the investment pipeline. I also think that when you don't have that access, it just makes everything significantly more of a struggle. Entrepreneurship itself is already a challenge, and when we kind of move forward with then adding, do you have the right resources to back you up, it just makes things even more of more frictions. And when I think of then how a lack of funding not just impacts a person and their mental state, and the fact that they kind of then operate under this realm of scarcity versus being to kind of think about things in a realm of abundance, you also have the challenges of, if you don't have enough money, you can't recruit your team that you need to execute. So it then blends into all the other areas that leads to business failure. So I think you just, and I don't know the statistics, but I would guess that you might see a higher rate of failures for folks who don't have generational wealth, because they don't have that ability to have that runway that they need to really get a business off the ground, which could take 1, 2, 3, in the case of hard tech, 5 years.
I mean, if I can add a little bit, if it's possible to follow Aaron, I'm going to give it a shot here. I think, my reflections on it that show up into the space that we operate in, into venture capital, partly what Aaron's talking about as a venture capital provider, is, Intergenerational wealth, comes with a couple of things. One, it's usually your first round of funding that you kind of plow into that first round of funding. You get friends and family rounds, and if your friends and family don't have intergenerational wealth, that makes it tricky. The second, and sometimes almost more important, is what happens is you're not necessarily surrounded by a network or a group who's gone the entrepreneurial route or who has deep connections within, I would say, the mainstream finance system, marketing, e-commerce, digital platforms. So the folks that you would normally tap into as an entrepreneur in the mainstream system just aren't there or aren't available. And it's a problem for a lot of different population groups. I'm speaking specifically here of Native Americans and Indigenous people in Canada. So there is that issue. Then there's the issue, I think, that we can talk about a little bit later, that is part and parcel of the reason why there's no intergenerational wealth, because of 200 plus years of colonialism and systems that are racially biased and racially structured against you. And this shows up when you go to get financing from non-Indigenous, non-minority based financiers, of which there's the vast majority of the ecosystem is not that way. And I'll just provide one example, that we have a business that we invested in significantly, that went to 170 different VCs before they found us. And we were their first founders. What's 170 pitches? Like, it's just exhausting to think of what people would have to go through. That number is not normal in the VC system. Yes, you do a lot of pitches, but that number is really outsized. Like, it's a very large number. So it's very time consuming. And then, of course, what happens is if you have good entrepreneurs, as Aaron hinted at, you get frustrated and exhausted mentally, and you just leave the game altogether. So part of our experience.
Arturo, you want to jump in?
Yeah, I mean, I think Jeff and Aaron covered most of it. The work that we do at MasterCard in financial inclusion, and trying to bring people who are excluded from financial services into the economic system, has taught us that when people are deprived of one aspect of their economic participation, say, they're financially excluded, the likelihood that they are also deprived of other important things, digitally included, financially literate in the first place, is higher, right? So these things are not just about fixing one aspect. They usually are like a snowball for folks. Same thing happens with business owners who are kind of first-time business owners or entrepreneurs. Jeff mentioned friends and family. Well, guess what? If you don't have intergenerational wealth, you not only just don't have something to invest, you probably don't have any friends or family that can invest in your first round either. You probably don't have any friends who can work for sweat equity as people with more privilege would be able to do. And so these things are additive, and you can't just fix one piece of them.
Yeah, that's really spot on what we've seen also through the interviews and through the report, and it's not only this one. There's others too. A recent Forbes publication that was looking at this issue. They state that about 50% of startups fail within the first 5 years, and it's really hard to start from scratch. Everybody loves like a beautiful story. We started from nothing. We became successful, but less than 30% of current business owners stated that they started with resources under $5,000 to support their endeavors. And to your point, Arturo, entrepreneurs closely tie wealth and opportunity, other forms of opportunity together. You have less opportunities, you have no access to capital, you're connected to less people, so you're deprived from relational wealth in many respects, and ultimately you're more likely to fail. So let me maybe pivot here to what do we do about it, and how do we help leap start entrepreneurs who don't come from generational wealth? Jeff, can I ask you pleased to maybe take a first stab at this.
Sure, I can relate how we approach the issue, what we've seen, and kind of our experience over the last 4 years. So there are a number of things that we can do. One is when we talk about patient and flexible capital, we really need to mean patient and flexible capital. So that often means at the front end taking a larger chunk of time. So this is high touch work, is what I would say for the investor in that space, to explain the different types of investment, the different types of capital, and what that does to the business. You know, where that assists and where that puts sort of, you know, constraints on it, whether that's, you can get into things such as, is it equity, is it revenue share, you know, is it, you know, convertible notes, whatever format it, and what the long-term implications of that for them in creating their own wealth. So we've taken to creating, you know, highly flexible cap table scenarios for people who have never touched a cap table before and understand exactly what that means. So it takes time. The other part about that, I would say, is that when we engage with entrepreneurs that we know we're going to move forward with, we're extraordinarily upfront about how the length of time this is going to take. I mean, average VC investments 3 to 6 months. You want to let them know exactly how long it takes. People want money tomorrow. Doesn't really work that way. We've even gone to the stages of trying to have legal agreements and investment agreements that are pre-structured by lawyers, so that we're not spending a ton of money on lawyers that both sides don't have, because they don't have intergenerational wealth to do that with. And what we do say to them is, we are entering into a relationship with you. We're not plunking the money and going to forget it. We're here to kind of build your wealth, and to work together on it. The other thing we do, of course, and some more practical things I think we talked about here, is we try to build peer networks, introduce them to other Indigenous, Native American CEOs and founders who are facing the exact same issues. So they have that stress relief, mental outlet, and of course, innovation about how everyone is handling this differentially. And this becomes very important, and tends to lead, excitingly, to some B2B relationships. The other thing I would say is, you know, we are looking actively at how to, and we've been doing this, it's a journey, not a destination, to decolonize the investment process so that we can make the investment process less feel like a colonial imposition. I mean, I can only speak for our people, but our relationship to money has not been exciting over the last 250 years. This is common with colonization, and so this trauma, money exists. And so we try to take that anxiety about money away and actually make it a tool of medicine. Is that how we refer to it? Money as medicine, as a common phrase for us. And try to change the entire experience of investing and help them get over their own intergenerational wealth. I mean, we're here to provide capital, so that helps. But and then we also network with other capital providers and try to take the lead on bringing in co-investments if they're large enough to handle the co-investment stage. And the last thing I'll say, because I feel like I'm talking a lot here, is our point up front as an Indigenous investor is actually to build wealth in the community, as I said in the beginning, to build wealth in the Indigenous space. So we will pre-structure our exits with structured buybacks so that those people know in advance how we can exit. So there's no unknown at the end should they choose to take that option. And it decreases anxiety. It builds more on the relationship. I mean, there's 100 other things that we do to kind of make this like a regular venture capital firm does as well, but try to make it, I mean, we want all boats to rise with this tide. We're not seeking the 2 unicorns and 18 to fail sort of scenario. That's just not us in any way, shape, or form. So hopefully that helps answer that question a little bit.
Yeah, and we do we're good on time, so let me stick with you for a second, Jeff, because there's a question from Queen Jade, and I feel that you're also going to have some interesting perspectives on this around the definition of wealth. And she mentions wealth could be relative, and individuals who have historically been excluded from wealth may not even know what wealth is or means, let alone how to get it and grow it. What's the approach in the communities that you're working with?
I mean, if you ask elders in their communities, they're going to give you a whole different lesson on what wealth is, and just so that it's clear to Queen Jade and others who asked the question, is, if I talk to an elder and you talk about the accumulation of capital, actual money that you're accumulating, they would tell you that's probably a sign of mental illness. Wealth isn't designed to be generated and held, it's designed to be generated and given away to uplift other people. So often in our communities, the chiefs or the leaders would be the poorest in the communities because they keep giving it away. Fundamentally, when we talk about intergenerational wealth in sort of the traditional capitalist sense, what we're talking about is, wealth that's inherited or brought into your family over generations that you can then access. Often that takes the form of an asset base, usually inside property and other kind of more liquid assets, stocks, bonds, and commodities and that sort of thing. One of the problems we have in communities that don't come from wealth is that there's often not owned housing. And if you can't use that as collateral, you're already behind the eight ball, so to speak. Like you can't leverage that. In some Indigenous communities where land is communally held, you can't leverage it at all. I think you've had some experience with that in the past, Erica, as well, in certain communities. That makes things very, very difficult for you, because if you go to banks they don't really care a whole bunch about your business plan. They really care about, can you make the payments and do you have collateral against that debt? Which is why we chose to work in the equity space and not the debt space. So what does wealth mean in this context? For the capitalist purposes of venture capital, it's what's the asset base which you can access to then leverage to help your business grow. All those things that Aaron talked about, who to hire, how can you do it, execute on a business plan, that sort of thing. In traditional Indigenous sense, it means something else. There's cultural wealth and relational wealth and those other things that you hold dear. Last thing I'll say about that, because you said we have time and I'm going to abuse it, is when we've done a bunch of surveys with Indigenous entrepreneurs, both those we invested in and have not invested in. And the interesting thing is that when it comes to the list of priorities for the entrepreneurs in starting their business, profit was about fourth or fifth down the list. What was at the top of the list was, how do I give back to community? How do I support my family? Like, it wasn't really about profit generation and taking it to IPO. And that really wasn't what it's about. And to this day, with most of these businesses, it's still not what it's about. If you ask our top performing businesses, of which some are extremely high performing now, what they want to do is generate wealth and then go back and invest it in other Indigenous entrepreneurs, which is exactly what we want. So once we're in wealth creation.
I'm going to come back to you in a second with a follow-up to that, and to yes, we'll come back. But I want to turn to Arturo for a second. Arturo, you have you're within an institution and you relate very much from a different perspective. Just wondering if you have any thoughts on how our whether it's public policy, foundations, institutions at large, are there things that could be done, that are being done, that you're seeing, or that you think should be done that can help with this issue to support more equitable startup phases for entrepreneurs?
Yeah, Erika, so I think there are things that we can do in the short term. Obviously, some of the problems that both Aaron and Jeff had pointed to are kind of long-term, deeper, more structural issues. I can talk about both, but MasterCard has a few commitments. One, global commitment to support 25 million women entrepreneurs and 50 million small businesses to basically achieve inclusive prosperity. And obviously we cannot support them individually, but as a network company that sits kind of in the middle of the economic system between banks and merchants and others, what we can do is deploy catalytic funding or catalytic partnerships. A few examples of things we've done in the US in particular is, for example, working with CDFIs, with community development financial institutions. We think that, as a proxy, they might not be as targeted or good as Jeff's funds, but as a proxy, they are closer to minority owners and entrepreneurs who might have a harder issue getting funding. And so we've partnered with the Community Reinvestment Fund, with Action Opportunity Fund, with Grameen America, and our interventions have actually been to help them digitize, so that through that they can connect to more business owners and more small businesses. So we've deployed something like $8 million in grants to CDFIs, and they've in turn enabled more than $7 billion of affordable capital in the United States. So that's the power of catalytic funding. We've also done kind of deeper connections with really interesting organizations. The second one I'll note is called C-Note, and C-Note is deploying $20 million that is going to underserved communities and to help women and minority-owned businesses. In particular, it's a women-led impact investment platform, and they have a really interesting model where they've actually launched with several banks and other foundations a tool where every dollar invested on their platform funds small businesses owned by women and people of color. So those are kind of like the catalytic short-term investments that we are making from a philanthropic perspective at MasterCard. I think for the long term, a couple of years ago, we wrote a report with the BCG Foundation called Build for All, in which we asked a bunch of experts and leaders of communities and leaders of businesses if they were to rebuild the economy to make it truly inclusive, what would be the fundamental pillars of that new economy? And we basically got to three. The first is everyone needs to have equal access to opportunities and resources. We need to equip everyone with the knowledge, the tools, everything they need to meaningfully, if they choose to participate in the economy. Right. And so if we're going to rebuild our economy, it needs to have that as a basis. But that's not enough. It's not enough to just, have everyone have, equity or access to resources, because we know that the minute that Aaron steps into a pitch versus someone that looks different than Aaron, that's where these kind of deeply rooted structural biases and sources of exclusion come out. And I read a really interesting example just last week in the New York Times. There's a professor from Baltimore who had his home valued recently, a professor called Dr. Connolly, and his home was valued at $472,000. And a few months later, he asked so he's a black professor. He asked a white professor to come and live in his house, pretend that it was his house. And they brought a second appraiser, and the house was valued at $750,000 just by changing the person who opened the door, right? And so, a clear example that there's a lot of subjectivity still in capital markets and all kinds of things, right? And so the second pillar is leveling the it's not just equity, it's fairness, right? It's leveling the playing field in the capital markets and in every market, in the labor market, etc. There are solutions to that. Australia, for example, to talk a little bit about the work market, they made it illegal to put anyone's last name on a job application. So you can't see if it's your buddy's son or daughter, or if the last name sounds weird to you. They've actually taken the name out, and it's just basically looking at the person. And so those are the kinds of things that we can do on the bias side. And the final one, I think Jeff alluded to this in the beautiful culture of the elders, is about investing in shared resources, so to make sure that there's equity and fairness in the next generation, right? We need to do a lot more investing in public goods. We need to do a lot more giving back so that everyone in the next generation has an equal chance to succeed. And so that's in our paper, Built for All, if you want to read it. But I think that's kind of the more long-term vision that we have.
Thank you. Thank you so much, Arturo. So I'm going to come back to both you and Jeff, because I wonder about investors' perspectives on some of the points that you're raising. But before, Aaron, you've had an incredible journey as an entrepreneur, and I was hoping that you could maybe share a little bit more about what have been the struggles, but then also what are the things that have helped you along the way and get you to the place where you are, that might be things to share with other entrepreneurs and with everybody that is hearing us today.
Yeah, well, I thank you for that question. And I think one of the things that's immediately helping me is the fact that we are having these conversations, that is becoming less stigmatized to talk about coming from poverty. And to talk about the challenges of tapping into, the capital pipeline and the resources pipeline. I recall a decade ago being very nervous to share my background because I thought that would be a notch against me. But now, over these last, I really say the last few years, there's really been a sea change, and people are more willing and receptive to hear it. And that's part of the systematic change that I think has been happening over the last couple of decades. But we're kind of reaching a point where I think it's starting to catalyze a bit more. I think the other bit of it is the folks that are doing deal sourcing are also coming from more humble backgrounds. As the investor climate and who holds the purse strings, but as that looks to change, and you are getting more funds like Jeff's, and more corporate funds like Arturo looking to actually make concerted efforts to do the thing, that's impacting it. And I don't think it's that shocking that if you are, I remember having my first pitch to a Black investor who could actually write me a check that day, and it was just like having a conversation with a friend. And I wasn't sweaty. I felt like I was able to chat. Ultimately, it wasn't a right fit and there was an alignment, but it didn't feel like there was something else holding up that determination. And then I think the last thing that's really changing is, it's changing because we're getting more founders like me who are thinking about diversity, equity, inclusion in our companies. But the wealth that we create, I think we halo and entrepreneurs, but it's really your team, right? It's the operators that are doing the work day in, day out. And those folks, when a company gets successful like Twitter, you create hundreds or thousands of millionaires. Those are the people who are writing those angel investment checks. And if they look like me, they come from my background, they've been sourced from that, you're going to have, like Jeff said, them giving back to their community, them putting money back into the community and building that pipeline. And we just need more of that, and we need more cycles of that more frequently. In terms of kind of how that's impacted me, I think I've just been a beneficiary of it all. I've also just not taken no for an answer. This is my third startup. I never anticipated to start 3 companies, let alone. What has changed is that I'm passionate about my mission. And I basically tell people, get out of my way if you don't want to help me. And that has, when we were raising our pre-seed round, I spoke to 150 investors before we got our first check in. I thought that was just kind of standard status quo. But I've also heard from other Black founders who were able to pitch just 35 investors. So I think there's a lot of change happening, and we're experiencing it and we're benefiting from it. My concern is that the door is going to close. The door, and I think it often starts to close when the market perception starts to go down and you want to just put your investments in what you view as safe bets. And we need to really start thinking about what a safe bet means and what that and who is part of that.
Thank you for that fantastic contribution, and congratulations. It's really you've had a really incredible and admirable journey. Arturo, Jeff, Arturo, you were mentioning, we need to reinvest more. We need to invest more in public goods. Jeff, you were talking about sort of like building the generational the wealth of next generations, the approach that you have with your entrepreneurs. In our work, one of the things that, one of the underlying premises of the work that we're doing within SecondMuse and SecondMuse Capital with the funds is this notion of like, we need to take some of what we generate and reinvest it back into the ecosystem. And that's not just, it's good from a value standpoint. That's how we can create more inclusivity, more equity, more fairness, but it's actually smart from an economic development standpoint. You de-risk your ecosystem, you can create greater conditions of success for entrepreneurs, and not just one cohort, but multiple iterations. It's been a really difficult conversation with investors and potential capital providers, where it's like, okay, there's still this expectation that in order to align incentives, in order to create more value for your investors and for those that are going to be managing, profits need to be concentrated in the hands of a few. That's where they see alignment. And this idea of reinvesting back into the ecosystem is either a distraction, not enough alignment, etc. But that has been sort of like some of the conversations or challenging conversations we've encountered, not all of them. But I was just wondering, are you seeing any traction with the concepts and the ideas that you've presented with broader stakeholders, or is that still an uphill journey and we need to be putting a little bit more effort into breaking some of those mindsets?
Arturo, should I go first? Okay. So yeah, I mean, there's about 100 things to respond to in what's been said in the last 10 minutes, but let's go with your question, Erica. When we first started raising capital for the first Indigenous Impact Fund, it was a significant uphill battle with all kinds of implicit bias, even in our friends, about who could deliver and who could not deliver. And, I don't know about your team, you're kind of white presenting, so we're not sure about things, anyways, all those sort of horror stories in day one. Our initial set of investors were small. They're kind of between 250,000 to essentially 1 million in the first half of the first fund raise. What happened after that is sort of, just pre-COVID, but is a great deal of energy started to come into the ecosystem, both in the United States and Canada, for various reasons. One, the Black Lives Matter movement in the US had a huge impact. And this is the window, I think, that Aaron's speaking of. The Truth and Reconciliation in Canada had a huge impact. So there was a broad base awakening to some degree, not with everyone, but with large sectors of the population, including investors, with investors kind of seeing that whether it's opportunistic or not, that they should be doing more, can be doing more, and should be doing more. Sometimes that was on the basis of the consumer base voting with their feet. I'm going to buy Nike, I'm not going to buy it. And based on how they act corporately, this impacted investors and that sort of thing. But what's happened since then has actually changed. The nature of the investors now are those who are actually aligned with the vision and the impact what we're trying to create. And the return profile is gentler in terms of what traditional venture capital would be seeking. And most venture capitalists, advertise these egregious rates of return, which, fewer than 2% of them ever hit. What we advertise is, we're trying to advertise honesty in it. In our first fund, this was a 6 to 8% rate of return for investors. We wanted them in for the right reasons, right? Along the way. What happened is now the investor base has changed. Larger and larger institutional investors are coming on board. This actually represents a change in the ecosystem. And in the second fund, this is even radically more different. It's almost all bigger investors globally. And within the United States and Canada, what we call Turtle Island, is much, much larger investors, seeing both, how the performance of the first fund. And what's interesting, I want to bring up something that I believe Aaron hinted at, was what we're seeing in our first set of investments, which are now somewhat mature, is a resilience in the Indigenous economy that is stronger than the mainstream economy. Now, we can try to hypothesize all sorts of reasons why that may be the case. But one thing is about the community connective tissue that happens with those businesses who are being supported at a local level in a different way and kind of globally at a different way if you're a products or service-based business. So there's a certain resiliency that in troubled economic times, as we're in now, I think is attractive to capital looking to be placed somewhere. So we're seeing a shift, and I think it's actually a big shift. Now the question is that an ever-closing window, as Aaron suggested? I think to some degree, yes. Where that changes, and I just want to pick up something that Arturo had said, and where I think catalytic capital can play a role, and all types of capital are needed, from granting philanthropic capital that grants, philanthropic capital that is concessionary inside investment funds, all through regular LP structures, is that what you need in this space is a whole bunch of very specific intermediaries, either women-led funds, Black-led funds, Latinx-led funds, because those managers like us, our hands are really in the soil with the community. And this is very important as we expanded into the United States. What we've noticed is it was by word of mouth. So our deal pipeline is actually extraordinarily large, all by word of mouth. 90% of our stuff is inbound now, which is really exciting, because what it shows is there's this whole ideation innovation spectrum happening in minority communities, which is finally getting some access to capital and is starting to so the end point of that story is that if I was a big investor, if I was a BlackRock sitting there and I had all kinds of money to play with, I would go, where is there an untapped marketplace? And I could say that I've had a few calls from folks like that who recognize that they could never do it. And so how can we help you do it and do more of it and sort of work with you and place our capital? I don't know. I can't even remember what your original question is, but I think somewhere in there I may have answered part of it.
Yeah, it was about, no, that was great, Jeff. Thank you. It was about investor sentiment and other stakeholders sort of like aligning with the work that you're doing and the approach that you're taking with entrepreneurs. Arturo, did you want to add?
Yeah, so I here I'm gonna speak kind of more of my, as a person observing the economy, the ecosystem, more than MasterCard. Just one thing about MasterCard, to Jeff's point, we have an in-house incubator called StartPath for fintechs, and we've just launched our first. We've always had DEI targets at StartPath, but I think, as you said, Black Lives Matter and other courageous movements have given us the opportunity to say, okay, we're going to launch a cohort of just minority-owned businesses. Like, I think that there was an inflection point in the last 2 years where we can actually go even further. And I do think I'm going to make another analogy to the world of the workforce to come back to investment. But I think that part of what is happening with the great resignation, or another call it the great whatever you want to call it, and this ongoing, I think, negotiation right now between employees, particularly in big tech companies, and employers, is that kind of inflection point where, and I hadn't thought about it from an equity perspective, but the research is starting to show that a lot of it is not just about the flexibility and remote work. It's about the environment that many of these companies had, which was very comfortable for privileged groups, right? Like white men, right? Felt that it was a great environment. And as soon as other type of people that were not as comfortable found the freedom to work from home and the sky didn't fall, there is a negotiation about what that needs to feel like coming back. So I think change doesn't happen in a linear fashion. There's inflection points. I think we're at an inflection point in terms of work, right? Where people are saying we need a different workplace, not just a different balance, but a different workplace, and that's coming out. I think the data point that you talked about, Erika, about you know, people with no generational wealth being 2 times more likely to say that the economy is not inclusive is one of those inflection points as well, right? Like everyone that was, privileged, that had the wealth, that kept playing in this very small ecosystem, was very comfortable with what was happening, and this is an inflection point that can open up and change it forever. So I'm pretty optimistic as a person on how this moment can lead to a much better economy for everyone.
Fantastic. Thank you. Thank you for that. There's a few questions that we have in the chat. So let me read you one from Michael, who says, curious, do any of the panelists know of specific efforts, incubators, platforms to proactively pair founders who benefit from their privilege, specifically their networks and intergenerational wealth, with founders who don't? In the same way that incubators like YC and others seek to pair technical and non-technical founders as part of their process.
I will say that I unfortunately don't. A couple years ago, prior to the pandemic, I started something similar to that just on my own to connect Black women, LGBTQ entrepreneurs, and other minority entrepreneurs to my network as it grows. And it's called Fitz' Startup Shop, but I unfortunately haven't invested much more energy as Mars has started to grow. But I'm hoping that just by having this conversation and that question getting out there, we can get more people involved, either through Fitz' Startup Shop or another entity. And I'd be happy to funnel all the leads that I get for folks wanting to get access, because there's not a shortage of people who have, I think, amazing, incredible ideas that just don't have the right entry points to either validate them or launch them.
Thank you, Aaron. Yeah, and it's in the context of our work, we all of these things come together under the concept of relational wealth, and I think that's a very big piece that intentionally across all programs we try to build and try to influence. And so at the end of the day, it's relationships that is more than networks, just pure networks. It's how we're in relationship with one another. Different stakeholders, founder to founder, investors, corporations, etc. But certainly something that needs much more attention and effort so that we can start to create some of those bridges. Another question that we have from, and I think this might be the last one, from Jeremy. Love the idea about reinvesting returns into the ecosystem. After all, it's resources of that ecosystem that lead to the success of the investments. Wondering how we can, one, recognize and value the contributions of the ecosystem, and two, encourage investors to return more value back into the ecosystem rather than extract that and return it to folks who are already wealthy.
I think Arturo has lots to say on this subject. No, I'll try to answer one part of the question without putting you on the spot, Arturo. And that's the second half of the question. How to encourage investors to return more. I mean, the only, I guess, secret sauce or magic that I would say that we've seen that kind of helps encourage investors is to build relationships between investors and the impact you're creating. And for us, that looks like building the opportunity for investors to, for lack of a better word, spend some time with the founders and some time with the process. And so what we've done, for example, is we have an impact measurement framework, and we invite our investors to come to a feast. Some of these have been on Zoom, unfortunately, and have sent them bundles in advance, especially when we birthed we consider it live. So we birthed the impact measurement framework, and we actually brought the investee portfolio companies to the same and have an opportunity for them to talk to each other without the investor firm in the middle as much. So it's an opportunity to do this handshake. What happens in that space is, I think there's a personal human reward to the investors about, oh, that's what my money is doing with this person over here. So it's it's just a way of creating relational value, so they can see if someone's going to remain behind a screen or a cubicle and do the investment, it's going to be very hard to create any kind of relationship where they're going to see that value for money, where they're not just doing a checkbox exercise. So that's part two, is just what we've tried to do. It seems to have worked because most of those investors have come back for a next round and kept going.
So I don't have a lot to say. I would say just two things. One is, if capitalism is to survive, and I think that it is being questioned in a way that in many decades it hadn't been questioned, basically since the end of the Cold War. We need to accelerate the rate of innovation in terms of different kind of social contracts around capitalism. People forget that there are a ton of different realities within capitalism, right? The Nordic model is very much like what Jeremy was describing there, right? I mean, 70% tax rates at the upper echelon is basically giving your money back to the ecosystem, right? And so, I mean, what has worked there, what doesn't work there? There's 46 guaranteed income experiments going on in the US right now in different cities, many of them very small, but some of them, like Stockton, a little bit bigger. There was a massive one in Finland. What have we learned about basic incomes and entrepreneurship? A lot of the focus is on employment and if people want to work, or if they study, or what they do with the money. Very little focus on the fact that in Finland the entrepreneurship rate exploded when people got a basic income, right? And how could that end up becoming a growth model for the whole economy, like de-risking early stage entrepreneurs? And so I think that the first point is we need a lot more innovation in public and private funding and shared resources and public resources to get to the right answer. I think to the second point in Jeremy's question about the models, B Corps, co-ops, nonprofits, stewardship, etc. I think the way to think about the future of the corporation, in my mind, is that it will be required to internalize every single externality. I don't think we're going to go back to a world where a corporation can be antisocial anymore. And I think that will fundamentally change what we mean by giving back to society. I think it's going to be completely ingrained in what a corporation is. And so funders and founders like the ones we have in the call, and investors like the ones we have here, will have now, in this new iteration of capitalism, a step ahead of everyone else. I think everyone else is going to have to follow.
Thank you very much. We're just at time right now, and there's a few more questions that are still pending. We will be sharing the recording of this webinar. We will be also processing all the questions. We are going to be getting to the questions that have not been answered, and then sharing that back with you. We're going to be coordinating with our panelists. I want to just say thank you enormously. Tremendous gratitude to you, Aaron, Arturo, and Jeff, for all your insights and your time with us today, and for everybody that joined us.